Good evening, everyone, and welcome to today's webinar, which is on mastering the three Ds of investing, which is diversification, discipline, and determination. So, my name is Yogesh, and today we are going to talk about all these three very important factors in the financial markets in any sort of investments you do. Diversification, discipline, and determination. Three things are completely important, and I think this goes literally in every part of our lives when it comes to discipline and determination, because there are lot of decisions we take, and it's not just about investments. Can be about anything from buying a pen to a plane. We are literally taking a decision every day and picking something. The idea is that we as investors, whether we are buying a stock or a bond or a real estate or anything, our minds are uh, flooded with so much information that at some point of time, it's very normal to get confused. And it's very difficult to just reach to that point where you feel, okay, this is the right thing, and I'm 100% sure that this is going to work. We are never 100% sure. There is no guarantee of anything. You get out on the street, you try to cross the road without looking around, there is a possibility of you getting into a danger. And similarly, we always have to protect ourselves. So when we cross the road, we look left, right, we manage our risk. Exactly in the same way, when I talk about investments, it's just like taking that leap, going out of the house, crossing that road to reach to your destination. And in between that, we'll find a lot of obstacles. We'll find a lot of rough roads. But eventually, the idea is if we are disciplined, if we are determined, and we have managed our risks well, we can reach there. And that's really important, guys. I see a lot of other people as well joining at the moment, so I think we are going to start now, because the idea is that everybody is here on time, and I also don't want to lose any time, and cover everything I can in this span of 40-45 minutes. So the idea today we are going to talk about is how we can be a disciplined trader, because a disciplined trader is a person who, or a disciplined investor, for example. There are a lot of rules, there are a lot of, there's a whole different attitude what a developed investor or a disciplined investor or a disciplined trader takes. And it could be, again, I'm sure a lot of you must have been already doing this. You must have read books about it, or must have seen a lot of influencers. It's not that I'm going to highlight anything new, but the whole point is, let's talk out loud about the mistakes we do, right? Because there are a lot of things which we can do a lot better in a much more disciplined way, but we are not doing it, right? So today is we are going to watch a lot of portfolios. We are going to see see a lot of portfolios. We are going to see a lot of investment opportunities. But again, as I said, this is a very informative and awareness session, and let's keep it that way. If you feel that the investment opportunity is good, what I'm showing it to you, please run it by your risk consultants first. See whether, because every investment is full of risk, and there is no such thing as risk free. There is nothing risk free. Even if you keep your money and not invest anywhere, you lose its value because of the inflation. So there is risk in even keeping your money with you. So we are going to talk about how you can be a disciplined trader. We are going to talk about how you can be a disciplined investor, and which are how you can diversify into different investment opportunities and manage your risk well. So I think that is something which we should today focus on. So let's start to understand how we are actually diversifying our investments, because this is really important, guys. We every single time somebody talks about diversification, we tend to think that okay, it's stocks and bonds, or stocks and or forex or commodities. The idea is to have a proper allocation, a proper spread of all these investments in such a way that it will be ideal if all of these asset classes were unrelated, because that's the best form of diversification, when all the asset classes amongst each other are not related at all, because that gives you a good hold. Like if one leg of your portfolio is going down, maybe other could be going better, right? So I think that is one of the most important things we should always look at. Second thing is, um, there is a timing to it and there is a composition to it. Allocation or diversification also requires a proper composition. How much percentage of your investment should be allocated to stocks? How much should be allocated to bonds? How much should be allocated to commodity funds, or how much should be allocated to any other asset class? That is really, really important. So, what you see, friends, in front of you right now, it's an investment pyramid, right? Investment pyramid, what an investment pyramid actually is. So, the investment pyramid, when we look at it, it's more like separate asset classes which you can invest into. But if you see the very beginning of the pyramid, which is the foundation, the base of your investment, the base of your investment starts with the fact that there is some money which you keep uh, fixed somewhere in your savings account, in your money market funds, basically 1 month or 2 month or 3 month treasury bills. The idea is the foundation of your investment pyramid consists of all those asset classes which has the least risk and least amount of volatility. So if you put your money in the bank, you earn a certain interest over it. If you put your money in a treasury bill, which is a very short term, 2 month or 3 month US government bond, you earn a yield over it. That's some money which you definitely should keep, because that's the money which is away from too much volatility. Yes, the returns in these asset classes could be less, but the safety is of utmost importance. So you see a lot of times, a lot of clients, they would put money in their banks where they earn a decent amount of interest, or maybe not, but here the objective is security and not really to earn a very, very good interest. So this is some money which you're keeping it aside, you're keeping it in a very, very safe point where the risk is relatively very less, least risk. The returns also, if something comes, very welcome. Then once you have that sorted out, you move up a notch. You start investing into slightly higher grade bonds. When I say high grade, municipal bonds or fixed interest securities, where you can earn slightly higher than your savings accounts. Those could be corporate bonds, those could be municipal bonds, those could be slightly higher yielding bonds, and you can invest into those. The objective, you're still two layers, the two foundation layers, we're still receiving a fixed rate of income. And that's the idea, right? You need a sort of verification, confirmation, a certain amount of fixed income you need for yourself. And these two layers of the investment pyramid, it helps you to get that regular income, get the clock ticking, right? Then you move up a little. Now you have your foundation sorted, you move up a little and you start investing into these blue chip stocks, real estate investments, all different kind of funds, commodity funds, much higher grade, slightly riskier asset classes, right? Even blue chip stocks, we are talking about blue chip stocks. Blue chip stocks means good companies, right? We are talking about here the likes of Apple, Amazon, we are talking about the Microsofts, we are talking about all sorts of companies. And these are big companies, Coca-Cola, Procter and Gamble, Johnson and Johnson. We have heard these names before, but we cannot deny the fact that at the end of the day, it's a company, right? So uh, just like Jet Airways, it was a company. Just like Wirecard, it was a company. Companies are uh, they can always go bankrupt, right? It doesn't matter how established the business is. If they don't, if they do a mistake, if they don't match up with the competition, if their technology get outdated, think about Nokia or BlackBerry, right? Think about all those companies which were bankrupt. So basically, if I'm investing into a company, even if it's the best company, one of the, like, I'm talking the likes of Microsofts and Apple and Coca-Colas, these are top class companies, blue chip stocks. But the point is, we have to understand that there will always be a possibility of a company to get bankrupt. That's the capital loss which we might face. So we have to keep that in mind. And at the tip of the pyramid, once we have our blue chip investments, our real estate investments sorted, we move at the tip of the pyramid, and that consists of speculative and emerging market stocks, junk bonds, options, futures. So basically, your day-to-day trading, your option-based trading, your trading in derivatives and CFDs and futures, that becomes the tip of your pyramid. So if you see, the risks and the rewards from the bottom of the pyramid till the top is higher. You can make a lot of money in options, futures, speculative trading if you're lucky enough and if you get your calls right. But the risk is also too high, correct? You are risking a lot, and that's why the higher rewards. It so you can lose a lot of money, you can make a lot of money, but when we talk about your savings accounts, you are risking very less, and you are making less returns also. So if you see, from the bottom of the pyramid to the tip, every segment, once you start investing, the risk in every segment continues to go higher, but so is the expected return, right? Investment in real estate or a blue chip stock would possibly give you a higher return than a bond or your money in your savings account. But then the risk in those asset classes is also much higher as compared to a savings account. So you have to diversify and allocate your money accordingly, that where and how much my money is going to be. But then you should always diversify. You should not only invest into stocks, you should not only invest into bonds, you should not only invest into real estate, or you should not just use all your money to trade or buy cryptos. That's something which is not the right thing to do. And that is a very I would say, not a very disciplined way of trading is something what we are talking about today. So diversification and discipline, they go hand in hand. A disciplined way to trade or a disciplined way to invest is when you diversify your money into different asset classes, as we just talked about. Right now, there are a lot of asset classes, as we can see. Asset classes, as I speak of, we always talk about stocks, commodities, forex. There are share baskets, right, which are based on themes. And this is something which is important. Bond, for example, real estate. Now, stocks, as we all know, we are talking about individual companies of stocks, right? Those who want to know more about asset classes, what they are, we have discussed asset classes much more in detail in our previous sessions. Today, since I want to discuss a lot of portfolios with you, so we are not going to emphasize more on the asset classes, but you can always go back on YouTube and see our previous sessions where we have talked very much in detail about every single asset class, whether it is stocks, whether it is commodities. Commodities, as we all know, mostly the natural resources in the form of metals like gold, silver, platinum, in the form of fuel like crude oil, natural gas, in the form of agricultural products like corn, soya bean, rice, wheat, sugar, etc. And commodity market is really, really huge. On daily basis, there are a lot of traders, investors who would love to invest into commodities like gold and oil and natural gas and silver also at the moment. And then we have forex, which is foreign currency, foreign exchange. Investors or traders, they like to invest or trade in euro, pound. Again, currencies, as we have discussed back in the past in much detail, that how a few asset classes are not really long-term worthy, and forex is one of those asset classes because currencies, once they lose their value, it takes time for them to actually go back to the previous levels. A big example of that is that how pound used to be above 1.5 versus dollar before 2016. And once the referendum, Brexit referendum happened in June, it's been more than 7 years or 6 years. A pound has never gone back to the previous highs. So if somebody just bought pound back then, has been continuing to hold on to those lower levels. And in those 7 years, the inflation in UK still continue to go higher. So currencies, as we have discussed before, may not be the ideal long-term investing asset class. But then if you are a businessman and you have exposure in pound or euros in some sort of payments you have to receive, then it can be a very good idea to hedge the currency risk through currency futures or derivatives, right? And then we have something called share baskets, which basically are themes, and it works. They work just like mutual funds, only they're very much theme specific. So if I'm talking about social media basket, which means you are investing into say 15-20 stocks which are related to social media, but you're investing into those stocks collectively, like how you do it with a mutual fund. And these share baskets are actually provided to you by a specific broker. The ones which I'm showing you are provided to you by Trade Ultra and CMC and a couple of brokers, but they do not trade on an exchange. It's more of a broker specific product. So that's why it's very much customized and very much theme specific. Then there are bonds, which have been talked a lot about of lately. I think a lot of investors at this point of time are holding bonds since so bonds is mostly a sort of promissory certificate by through which you give a loan to any government. In case of a US treasury bond, I'm talking about US government. You as a bondholder lend money to US government, and US government uses that money for government expenditure, and in return of the money they have borrowed from you, they promise you to pay interest every year, which is called a coupon, until a period of time which is called the maturity period, until your bond becomes mature, basically when you get your money back. So it just works how the banks work for us. We kind of become banks to the government by borrowing, by lending them money and becoming the bond holders. And this has been a very popular form of investment, especially now when central bank has raised rates. And on an average today, if you buy a US government bond, you get yield around 4.5%, which is pretty good because in last 10 years the bond yields were very low because interest rates were pretty low. So that is also one form of investment currently we are looking at. uh, Now this is ideally not, I should not be putting cryptos into an asset class, because at the end of the day, cryptos is something which is a lot more riskier than any other asset class, in fact, because cryptos are not regulated. Yes, uh, blockchain is a promising concept, but then cryptocurrency is just a small part of what blockchain is capable of. So I think blockchain as a technology can be invested in through different ways, through different companies. But cryptocurrency, anybody who invests or buys cryptocurrency for long term or short term, please make sure that you are aware about how volatile and how dangerous and risky the investment can be. Because we have seen Bitcoin and other cryptocurrencies, they have moved in a really wild manner in last few months, weeks, and years. And I think when it comes to understanding the rationale or any sort of correlation with the markets, a lot of investors, they have basically failed to connect the movement in cryptos with anything else. Earlier, it was termed as a digital gold, but when stock market started falling down last year, we saw Bitcoin also started falling down. So we're not really sure that how cryptos can be asset class, but then because it's been talked a lot about, so I thought I'll probably introduce you to the cryptocurrencies. It's unregulated, it's highly volatile, it's not backed by any sort of reserve. It's not like gold, as gold is reserved by a physical underlying, but crypto is not reserved by any physical underlying. There are no schemes or compensation schemes to protect. There are no regulators to protect you against this form of investment. So be very careful. Again, it becomes one of the most speculative and high risk asset class here. Now, talking about diversification, there are a lot of ways you diversify because there are a lot of industries and sub-sectors and sub-industries which continue. And every single time we have seen that the economy goes through a very different phase, and those phases are called peak or boom, normally what we call it, when there is a lot of acceleration in the economic growth. And after a certain point of time, that growth becomes saturated, and we see a positive but a very moderate growth. And then at one point of time, the growth rate slows down, and then we fall into recession. And then again, from recession, there's a recovery, and the cycle goes on. But while we are going through these economic phases, we should always remember that there are different industries which work well in different economic cycles. Like when things are going really good, economy is on the verge of growing, and the growth is much, much more accelerated. Um, we see sectors like consumer discretionary or financials or industrials, IT sector. So if you remember 2021, there was a fast recovery after pandemic and markets were going high. Or if you see, I should ideally tell you before pandemic, because 2020 was obviously a breakthrough for tech stocks. But then if you see pre-pandemic, we saw 10 years from 2008 to 2020, 12 years, that how stocks have continued to go higher. So post 2008 recession, there was a lot of quantitative easing, dollars were printed, injected, stimulus came across every single time. So we saw during this phase all the luxury stocks, financial companies, industrials, construction, materials, real estate, this stocks continue to soar higher. And after a certain period of time, now when we see last year, we have seen IT stocks have started coming down. So at this point of time, a lot of investors are investing into quality companies, but not too much into tech. I mean, technology is one of the important part of our world now, because if you speak about Mastercard, if you speak about Visa, if you speak about Facebook or Apple or Google, we know, or Amazon for that matter, we know that how significant investment in these companies are. So we cannot completely keep our portfolio without these stocks, but more allocation should be given to utility companies. As you see in the last phase, people are talking about an impending recession. But I'm not sure when we reach there or are we already into it. But it will always be a good idea to allocate your money towards consumer staples or healthcare or utility companies. The idea behind this is very simple, that if you're looking at whether there's a recession or not, you still have to pay electricity bills. So utility companies, healthcare companies, consumer staples companies, these are some sort of sectors which help you during the recessionary period. You can always invest into it because they don't move, they're not very volatile, and they give you a fixed dividend also. So ideally, Coca-Cola, for example, has a 3% dividend yield, and there are a lot of other stocks, utility stocks, which have dividend yield around 3 to 4%. Tech companies, they don't have dividend yields. Tech companies, they move very wildly. So you have to decide upon, and that depends on your risk appetite, which you should determine for yourself. So it depends on what sort of strategy you have. If you have a defensive strategy, you're looking at utilities, healthcare. If you want to be opportunistic, if you see that the economy is growing and you feel that you need to earn some returns, IT, as I said, tech stocks, they tend to move higher, but they are very volatile also. So are the luxury companies. Similarly, a preemptive strategy when you're expecting high inflation, as it was in 2021. We started expecting a higher inflation. Inflation started going up, and to protect your buying power, you start investing into energy companies or materials or real estate and those kind of companies. Now, coming to the idea how we can diversify our investments into different things. First of all, there are different ways you can actually invest your money. There are different ways you can allocate your funds. And how does that work out? Because uh, the first and most important thing is it's not just about buy and hold. You don't just buy and hold, because a lot of investors they they know they know the strategy that we just want to buy a stock and hold on to it. That's how Warren Buffett made money. That's how everybody makes money. But the fact is that's at this point of time you have to be more and more active with your portfolio, unless you don't have a time and you feel that this is where I need to be more careful, and I don't want to invest on my own, or I don't want to trade on my own or invest. I want a fund manager for me to do it. Still, you need to be very active, because at the end of the day, there are a lot of things changing right now. And it's not just about buying and holding. Today, you can look at different asset classes. Now, I'm going to share some portfolios with you, and these portfolios, I hope, this is we have made few of them. We have made most of them. We have made this month. Some of them previous, but a lot of these companies we have shortlisted out. But please do understand your risk and reward behind this. This is just for your information purposes. This is not a recommendation of any trade. Please understand, be informed about this portfolio. Talk to your risk managers that if this is something what you should do. So very quickly, let me just share my portfolio with you. So let's start with EV stocks portfolio. EV is a very, very growing market, and I think it's still growing, because now is the time when people have actually started looking EV as an investment. Because earlier it was just Tesla, everybody talked about Tesla, but I think now there are a lot more players which are actually entering into EV segment. And if you look around, there are, even in Dubai, if you see, a lot of cars are just getting expensive, and especially the petrol versions, because the supply of these cars have reduced, and a lot of governments now are still focusing on making environment cleaner and greener, and hence the next 5 6 years are probably going to be very revolutionary for electric vehicle companies. So I wanted to have a look at these few picks, and of course the description is written over here. We can send you these portfolios if you like to. On the, just to give you a tabular summary of what companies we are talking about, there is Tesla, there is Li Auto, and if you see on the second last column, the market capitalization is mentioned in billion. What is the total worth of the company in $1 billion? Market capitalization is also mentioned. And the 52-week low and 52-week high is also mentioned over here, along with the current market price, which is in the middle. I'll just zoom this a little bit more, so I hope that everybody can see this. Then there is the analyst recommendation also by Bloomberg, which again, recommendations can vary analyst to analyst, but then at the end of the day, we are just giving you a consensus of what the analysts on Bloomberg are saying. So if you see these companies, Tesla, Li Auto, Neo, Volkswagen, Xpeng, ChargePoint Holdings, and then there is Rivian Automotive Inc. There is BYD. And if you see Plug Power also, and Brookfield Renewable Partners. So the market prices as of what you see was around 3rd of May. Of course, there must have been a few changes over here, but each one of these companies, if you see from the very beginning, each one of these companies have a certain amount of understanding, a certain amount of work which has been put into, and a promising comeback. So basically, Tesla, we have seen again, Tesla has been in the news for too long now. But at one point of time, EV meant Tesla. But now there are other players which have also come. And investment, as I said, this is a ladder investment style. So since we are talking about diversification, we should be talking about how you diversify and how much allocation when you should enter and exit. That is also one of the most important things. So under a ladder investment style, you don't whatever money you want to allocate to your investments, you do it in different phases. Like for example, this is a portfolio worth $500,000, right? This is just an example. You can check with your amount more or less, whatever you like to. But if you want to invest $500,000 into this portfolio, so you should be doing this in different entry phases. And as you see that I have prepared this with different entries. So for example, entry one, 20% of your total investment you should allocate between these companies right here. So 3, 6, 9, 10, 20% of your investment should be allocated in this 10 companies, and that's your first entry. If the stock price drops, let's say Tesla from 160, if it comes to 140, is your second entry point. These entry points are calculated on the basis of technical support prices. Basically, the prices from where when the stocks drop, bounces back. And on an average, if the stock price has bounced back from that particular price, it becomes a strong support, which also becomes our entry point. So entry one, entry two, when you are again, when you're entering into this, you're trying to average this stock at second entry, 30% of your total investment, and then the remaining 50% you should do at the third inventory if it falls down, third entry. So this is how you actually do a ladder investing style. Whatever is your total income, 20, 30, 50, depending on your risk appetite, guys, again, because these are a bunch of EV companies. You're diversifying, but you're diversifying in within EV. So you're still very close to the risk if EV doesn't work, if electric vehicles doesn't work, if this entire technology or sector doesn't work, then you lose. But within EV, you don't have to invest only in Tesla. You should diversify into different companies. So there is Volkswagen, there is Xpeng, there is ChargePoint, and all of these companies, right? So if you see the portfolio allocation next, right here, 1 second, right here, if you see this, these are your phase one, phase two, phase three total. So phase one, 20%. So if you see this, I'll tell you how to read this. Phase one, the 20% of money, what you are investing into these 10 stocks, the percentage what you should invest. So out of 20%, 3% you should put into Tesla, 1.5 into Li Auto, 1.5 Neo, 2% Volkswagen, 1.6 Xpeng, Charge 0.2%. So within these 10 also, your 20% should be allocated in such a way that one specific stock does not get a very high weightage also. So you have Tesla at 3%, you have Rivian Automotive at 2%, then you have ChargePoint also at 2%, and you have Neo, Li Auto at 1.6. So just like that, every time you enter, your percentage will be allocated to these 10 companies in a way. So this is how basically a to ladder portfolio looks like. And again, these are different companies. So if you see Tesla, for example, uh, there has been a lot of bullishness surrounding Tesla. And again, Tesla is continuing to produce. They have been mass producing electric vehicles, and a lot of these electric vehicles in US have been affordable. Again, it is one of the first auto companies to build itself from the ground up to mass production. It's been 5 decades of work. So it if we see Tesla, it's not just a EV company, but it is also one of our artificial intelligence company. We are talking about SpaceX projects. We are talking about, and this technology is very much in-house. It's Elon Musk is working behind it. So if we see overall, the sale of electric vehicles are expected to grow and I'm talking about 2030. If we are talking about say another 6 7 years, the sale of EV should be growing at a very rapid pace. And a lot of analysts they estimate that one third of all these vehicles will be sold. Like if you say by 2028, one third of all the vehicles will be EV, which will be sold. So that's why if you want to take a decision today, electric vehicles expectation is pretty good. In the next 5 years, one third of the global vehicles will be EVs, and I think the proportion will be increasing by more than 50% by 2035. Now that will be a very big jump. Now coming back to Tesla, I think it has by to 2030 Tesla will still have 10% share over the global EV cars which they will provide, and the revenue growth should be around at least 20%. And currently, the stock has gone down by 40 45% in last 1 year. But again, it is one of the dominant manufacturer of electric vehicles on this planet, and there is a lot of AI, uh, artificial intelligence, innovation, and technology, which is also coming along with a clean energy production and storage. So Tesla is again one stock which you can look at, but then again, not just Tesla. Then you look at Li Auto, which is a China's very renowned electric vehicle market. And Li Auto also they design, they develop, they manufacture premium smart electric vehicles. So in China, it is one of the like you see China itself, it's world's largest electric vehicle market, and that's why China has a very massive competitive advantage because year over year, if you see the auto sales in China have gone up by 9% in March, and that is after the very stringent lockdown, right? So expectation for 2023 is very positive because then the if you see the price of these vehicles which are manufactured by Li Auto are less expensive. They have SUVs, they have a lot of other cars, and there's a lot of pent up auto demand because China is reopening. We should always remember this that China has been for a lockdown forever and now it has reopened. So there's a lot of pent up auto demand which consumers are itching to buy, right? And again, if we see numbers also in 2022, the revenues have grown for this particular company. And I think at this point of time, it may not be the worst thing to invest into a Chinese company since the stocks have been down for quite a while. So I think that is something which we can also look at. And as I said, since we are diversifying within into EV, if you look at NEO, for example, so NEO is also a Shanghai-based company, and it's also into EV. And if you see there, as we are talking about, a strong demand from China will be a very key catalyst for the profitability of these Chinese EV companies. And if you see the raw material, the lithium has been declining for a while. Uh, so that is something which is also going to help companies like Leo Auto or Neo to reduce down or keep a lid on the production cost. So these kind of things are really important. And I think the most important part is electric vehicles involve batteries. And now, if you see, as compared to 2022, in 2023, the battery prices are also gradually declining from their peak because the supply chains have now started to normalize, which were blocked due to COVID. So I think NEO is also one of the stocks we can look at, followed by Volkswagen. And now, if you see, Volkswagen has been very active, and they have been coming up with all electric cars, and that sale has actually increased by 40 41%. If you must have heard about ID4 and ID5, because that's 60% of the electric cars with the total volume which Volkswagen is committed to. So at this point of time, I think Volkswagen is a very branded name, and if you see their car making history at this point of time, it's a very branded name. It has a very unique competitive position. So this is also something really important, because at this point of time, all major economies are implementing policies that drive EV adoption. So that is something which is, again, I think Volkswagen is one of the important brand names, and you can look into it. Xpeng, again, it's a Chinese company with EV, and again, as I said, that we are looking at a lot of China-based companies. We are looking at a lot of companies like BYD, for example, which is also a Chinese company, because China is the world's largest EV market at the moment. So, like this Rivian, for example, is also one of the companies, and Rivian stock went down around 18%. A lot of negative news came out because their earnings report for Q4 was very disappointing. The analysts expected something else, and the revenue and the earnings both went down. Their own production target for 2022 was missed. So that was also something which was terrible news, and the stock fell. And then the Rivian has announced a recall of a lot of their vehicles, because there was some airbag problem, and that was a big quality control standard issue. So the stock has been actually falling down a lot. If I were to say that the IPO price at which the company went public with in November 2021, it's almost 90% down from their IPO price. So I think at this point of time, there are a lot of setbacks which have happened, but then this company has a lot of potential in the electric vehicle market. They have a main plant, and the production capacity, which is something really important. The production capacity is around 150,000 vehicles, and they're planning to expand it to 200,000 vehicles per year, and then eventually increase to 600,000 vehicles, because they're putting up a second plant in Georgia. And that is important because they have already received massive orders of 100,000 electric delivery vans from Amazon, and that is something which is huge. But then again, I would say all of these companies, Plug Power, Brookfield, because EV is itself a very growing and an emerging sector, it's high risk. So this is one of the most important things I want to tell you, that this is something which you should consider, but then you should also consider the risk behind it. EV itself is a very growing market, so we should always remember that there is a lot of risk behind these companies. As I said, that Rivian, for example, is 90% down from its IPO price. Why would you invest? So a lot of aggressive investors who would want to invest in this stock, uh, currently I mean, a lot of investors are very cautious, but then uh, a lot of investors, they expect that the company will make a meaningful progress, since the supply chains are now getting better. And overall, the potential of the company, is, I think it's one of the major players in the EV market. It's very promising. These setbacks which have occurred currently with the company, it might stay for some time, but eventually we are looking for a very longer term perspective. So again, guys, EV portfolio is one way that where you're investing right now, a part of your money. Ideally, looking at your risk appetite, please consider your risk before you invest into any of this. You can always talk to your risk managers, lay down a plan, that what are your future liabilities, when do you want to retire, how much risk you can take with this money. And all of these things are actually really, really important, because portfolios are made for all sorts of investors. A lot of these companies are, some of them are very high risk, some of them are slightly less risk. But then, as I said, that EV itself is a very volatile category, and I think we should definitely diversify, but be cautious also. So within EV, these are a few companies which you can look at. Now I'll also show you a different, a slightly different portfolio here. Let me just switch back to slide and so let me show you another uh, portfolio which you can also look. Again, guys, copy of these portfolios can be, you can just ask your relationship manager and they'll be able to send you the copy of this portfolio. Just 1 second, I can shoot. Okay, now I would move on to another sort of ladder portfolio. Okay, but this is not just about EV, right? This is a ladder portfolio which has, click it. Yeah. So this is a ladder portfolio which is a different one. This time we are talking about different stocks. This has a mixture of stocks and bonds. So as we are talking about diversification from one asset class to another, so within stocks, right now we discussed EV in different companies, and now we are going to discuss about stocks and bonds. And but these stocks, what I'm talking about right now, these are different names. I think none of them is into EV because EV is separate. But you can see these names. I'm sure you must have heard this. I'm talking about Bank of America, Marriott International, Microsoft, Coca-Cola, Amazon, Johnson and Johnson, uh, ING, Bayer, ASML Holdings, Delta Airlines, and these kind of companies. So if you see a lot of them, a few of them are utility stocks. A few of them, as you can see, are financial companies. Coca-Cola is food and beverage. And this is one of the important things, guys, because we have to uh, allocate our money to different industries, different categories, right? So currently, if you see, just like the previous ladder portfolio, the second part is in German bonds and US ultra bond also. Just here, if you see the investment style. Now here in this ladder, again, three entry phases, and whatever is your total investment amount, you start with 15% with entry one, and investing into these stocks, and then 40%, and then 45%. So entry one, entry two, and entry three. Within the first phase of entry, which is 15%, out of that 15%, so right here, if you see, this is investment in phases, this is in stocks. And then in bonds, if you see the first phase of entry, 60% now, 25%, and then 15%. If you see that we are putting 60% of our allocated money for bonds, 60% we are putting now because we are already into a very high interest rate environment, and currently the bond yields are high. Depends again, there is a possibility that if price goes down, we can enter again, and different three phases. So if I were to show you a portfolio synopsis, since we are talking about allocating, again, this was its allocation is related to $1 million portfolio, but then you can put it a number to you. It could be 100,000, could be 2 million, could be 50,000. It's up to you. But if you see how we have allocated this, it's a 60-40 portfolio with 60% into equity and 40% into bonds. If you see this, 60% into equity and 40% into bonds right here. So this is their allocation at the moment, right? Now again, guys, we are looking at a lot of these stocks. We are looking at the stocks like, if you see here to begin with, we're looking at Bank of America, which is currently priced. I mean, the date when this portfolio was made, I think this was somewhere. This was somewhere around 27th or 28th April. But since we are talking about longer term, so I can still share this with you. And we are talking about different stocks here. We are talking about a Bank of America. They have an excellent first quarter. The earnings topped expectations. Profits are up. Their earning per share is up. Expectations are brilliant. I think there has been a lot of organic client growth in this particular bank and across businesses. The deposits, a lot of deposits have been done. Earnings are very well diversified. Uh, if you see the income which comes from the interest and non-interest, I think both the sources are doing really well. And at this point of time, last year overall, if you see compared to last year, the stock did go down. If you see Bank of America's dividend, if you see, has grown 15% over the last 5 years. This is really important because um, one more thing which you need to know about Bank of America is that this bank has a very strong culture of sound risk management. And in last few years, even when the stock has come down, you see the dividend has continued to go higher. So you need this from your stock, a regular dividend, an increasing dividend income, and less volatility. So Bank of America is one of those companies. Second is Marriott International. Now we are talking about hotel and restaurants industry. You see how we are also diversifying industry wise. One was financial services, and now we are into hotels. So, and Marriott, as we know, it's one of the biggest hotel chain in the world, and they have around 8,000 properties, 1.4 million hotel rooms, and again, Marriott has done a great fourth quarter results. Their earning estimates have beat the Wall Street expectation. Their 2023 outlook is again very good. And at this point of time, I think post pandemic, the global recovery statistics, if you see for hotels, um, lot of hotels are now inching very close to pre-pandemic levels when we talk about the performance and the growth. The worldwide demand recovery has continued to go higher, and I think the economy is rebounding. People are rebounding. They are traveling more at the moment. So I think again, and we should not forget that China is reopening. So there is a lot of resumption of business and travel, which could again happen. So Marriott is one of those companies. If you see Microsoft, now we are moving on to a tech at this point of time, which again, Microsoft had superb third quarter earnings. They beat down Wall Street expectations. They already have their cloud service running, I think it's called Azure, and it has shown more than 25% year over year growth. So their AI and cloud computing segment is getting better. And if you see Alphabet, for example, they're doing better than Alphabet in when it comes to AI and cloud computing growth. So I think that is one of the main uh, revenue drivers or growth drivers for Microsoft. And one thing which you need to know about Microsoft was an early investor in OpenAI, and they injected $1 billion into this startup, and this was in 2019, right? So if you see, OpenAI is the company which has Chat GPT, and it has been a very recent success. And right now, Microsoft has agreed to a new multi-year deal, and that is rumored to be around $10 billion. So this again, uh, there are a lot of other revenues also. Search advertising, for example, um, around 40% of the revenue, and then again, there is a lot of advertising business which Microsoft has opportunity for using AI. So I think Microsoft is also, we are looking from a very long-term perspective at this moment. Now, moving on, there is Coca-Cola, which is a very good dividend stock. They have shown a very significant positive transformation in last few years. It has a very profitable business model. Dividend payment is top notch, and it's one of the most sensible options for the investors at this moment to get into it. Right. So, guys, again, you see, every sector is different over here. Delta Airlines, for example, if you see, we are picking up airlines also. Then there is Johnson and Johnson. All these companies you can look at. There's a pharmaceutical company called Bayer, which is also a part of this portfolio. And Bayer has been able to successfully launch some newer drugs. for prostate cancer and treatment and Nubica, and their sales have continued to go higher. So I think these kind of companies you can look into, because I think what we are looking for is economic moat. Like in Bayer, for example, or like other major pharmaceutical firms, Bayer's also has a sizable economic moat, and they have a very broad portfolio of pharmaceuticals, and they have patents, they have increasing number of biological products. So I think they have a worldwide sales force and a very strong brand power, right? So I think, and again, a promising dividend is what we all are looking at. So these kind of companies, if you look into, they have good dividends. As I said, you can check these portfolios. You can ask your RMs; they will send you these portfolios. Have a look at it. Talk to your risk managers, and then you can discuss more about it. Another strategy which you can look at, since we are, as I said, talking about diversification right here, we should be looking forward now a slightly here into ETFs. If I can show you here very quick. So again, there is another ladder portfolio right here, and this is for ETFs. If everybody can see it, and 60% allocation ETF is to equities, 40% allocation is to fixed income securities, which is bonds. And right here, if you see, again, since markets have gone up already from the lows, 20% allocation is recommended in phase one, by an equal allocation of 40%, phase two and three to capitalize if markets come down. As far as bond markets are concerned, Federal Reserve is nearing the peak of the rate hike. So maximum allocation should be recommended in phase one, followed by 20 and 10% in two and three. So if you see this right now, this is the portfolio snapshot, and we're looking at few ETFs right here. SPDR S&P 500 ETF right here. Then there is Invesco Triple Q Trust Series, MSCI Emerging Fund, Select Dividend ETF, ARC Innovation, Core S&P Small Cap, Consumer Staples, Gold Shares Fund, then investment grade bond factor ETFs, and then there is bond ETF for municipal bonds, and then portfolio aggregate bond ETF. So guys, again, this is a ladder portfolio for ETFs, and we need, as I said, apart from individual shares, we need to invest into some funds as well. And as you can see, the allocation, the investment style, as it said, for stocks, because a lot of markets have already rallied from the previous low. So first entry should be modest, and we should wait for markets to get corrected, and then we can put major amount of money here. As far as bonds are concerned, since Fed is reaching closer for the rate hike, I think they're peaking the rate hike. So at this point of time, 70% should be invested into bonds at this point of time, right? Now, if you see this SPDR S500 fund, all of these guys, if you see this right here, all of these funds, SPDR S&P is world's largest, heavily traded fund, and it offers exposure to S&P 500, right? It's a very well diversified basket of assets. And if you talk about IT, you talk about healthcare, financial, communication services, all these sectors, all these industries are into it. If you want exposure to large cap US stocks, I think this is one of the best funds you can look into. And if you see 3 years return on an average, it has generated is around 14%. And at this point of time, I think a lot of large cap US stocks, this stuff, like among a lot of active traders, this particular portfolio, the ETF has become very popular, and followed by Invesco Triple Q Trust Series, which is tracking Nasdaq performance. And Nasdaq, as we know, it's a tech-heavy index, right? So I think there are a lot of ETF, like basically this ETF also tracks Nasdaq. Nasdaq tracks companies like Apple, Microsoft, Amazon, Tesla, Google, all of these companies. So the idea is again, because Nasdaq fell down last year around 30-35%. This year till date, Nasdaq has gone up by 20-22%. But funds we are talking about from a very long term perspective, right? So I think there is a lot of growth which is remaining, because right now we are still in a very high inflationary environment, and there are a lot of uncertainties. We are talking about US debt limit, which is one of the most important events which is happening. Talks are happening every day, but there is no conclusion. Obviously, all of us expect that the US is not going to get default on their on their obligations. But then at this point of time, the markets are still very choppy, still very volatile, looking ahead of what's about to happen. So I think if we are investing into these kind of ETFs, we are looking at whether we look into triple Q or S&P 500, or for example, emerging markets, which is the third one. If you see uh, in 2022, there, like if you see, there has been a very macroeconomic backdrop for emerging markets, and there were a lot of challenges also for emerging markets. But if you see 2023, uh, I think there has been, if you see, US dollar is expected to get weaker, because again, there has been a lot of discussion about what is going to happen to dollar, and one can only anticipate how attractive an investment opportunity will be into an emerging market. And we are talking about those nations with robust fundamentals, right? India, for example, is one of the important emerging market you can look into. There are ETFs which are, so emerging market ETF gives you exposure towards India, Mexico, Brazil, Indonesia, South Africa, right? So it's one of the best tools you can look into. There are a lot of emerging market countries which are tracked under this 1300 plus stocks into it. And if you see the top geographical allocation, it is China, Taiwan, India, South Korea, Brazil. So I think this is one of the most important and better emerging ETFs you can look into. And I think this is also something really, really important, right? A lot of people are only invested into either India or US, Europe, UK. But through this fund, you can get exposure to 1300 plus companies related to different industries and related to different emerging market economies also. The rest, again, as I said, guys, these portfolios can be provided to you. Just talk to your RMs, they will give it to you. The other funds are related to innovation, dividend based funds, you can always look into. And then, as I said, investment into bonds, which is related to, so these were the ETFs, stock based ETFs. There are bond based ETFs also, investment grade bond factor, municipal bond trust, and then portfolio aggregate bond ETFs. So all of these, I think, you can always look into. And this is one other thing. Now, before I leave, I think one more real quick portfolio which we can see here. Let me just quickly go back to the slide and open the other one. So this is the investment, this is the product analysis, guys, for a Euro bond, which is basically a German bond right here. If you see, so we have been talking about stocks, bonds. We have been talking about ETFs related to gold, ETFs related to emerging markets, related to bonds. We can also see specific bonds like Eurobond, for example, right? And this is slightly a different product, um, of a lot of investors would either not look at it or don't know how to take advantage of it, because this product is available on our platforms in a form of a CFD. And CFDs have one important element, that there is an element of holding cost, because a lot of CFDs are available on spot, and normally a lot of bonds are available in spot and future. But sometimes when the spot bonds are available, uh, they provide a factor called holding cost, or a swap. Basically, if you buy these bonds, you receive a certain amount of uh, interest over it. And that interest can vary, it can change because the calculation is based on the pricing between the spot and the future. So, whatever is the difference between the spot and the future contract of these products, that difference is taken and a significant amount of math is done to identify that what interest should the investor receive, and that happens in CFDs a lot. So that's why we have few derivative based platforms, and for those clients who are interested, just to give you an idea, Eurobond or Eurobond as they call it. It's a government bond issued by German federal government, and a lot of these bonds they have maturity ranging between 8.5 to 10.5 years. It's a sovereign debt instrument. So basically, just like how treasuries are for US government, Eurobonds are for German government, right? It helps the government projects, expenditures, and everything. So now we have Eurobond futures available on our derivative platforms. And we also have a Eurobond cash. Now, the point is investors can earn a holding cost on the cash contracts on the derivative platforms. So idea is very simple. You receive, and I'm talking about non-leveraged at the moment. You receive 2.89% holding cost on your portfolio if you buy a Eurobond. And the price analysis is very simple at this point. If you see, these are different scenario analysis here. We are talking current price as say 136 euros. And if let's say, so let's look at the fundamentals first. Where is European Central Bank at? This is, guys, one of the last strategies we are looking at. So European Central Bank at the moment, right here. So European Central Bank initiated a smaller interest rate hike of 25 basis points in May 2023, bringing rate to a 15-year high, deposit rate 15-year high at 3.25%. Now, inflation has declined to 7% in Europe, but then there is a possibility uh, because they want to reduce it down further, there can be further hikes in the interest rates. Uh, to in a layman language, what happens is to control inflation, a central bank increases the rate so that basically the currency becomes more stronger, right? And the inflation reduces. Now, the idea is that if central bank increases rates, it's going to reduce the prices of the German bonds. But since we are also receiving a holding cost on this, the price to which it will be reduced, our loss to our risk to reward ratio is slightly better. We are risking in a non-levered way, in a non-leveraged way, we are risking around 1.6%. If you see here, this is the scenario analysis. Our maximum loss could be, or at least our loss should be 1.6%, where our profit, if we make a profit, it could be around 7.8%. Depends on whether the yield of the German bonds will go up or go down. If yield decreases, it's good for us uh, because the price of the bonds will go higher if the yield goes down. But if the interest rate increases, that is going to increase the yield of the bonds and reduce the prices, right? So what we have to understand about these products is uh, for a very longer term. So you will ask that if we are making money, if we are making money, if the central bank uh, reduces the rates, because the central bank reduces interest rates at that point of time. Just give me 1 second, guys. If the central bank of Europe increases the rates, that is going to bring the bond prices down. But if they reduce the interest rates, that can push bond prices higher from German. Now, the point is the chances are that they will continue to increase the rates. If they increase the rates, that will drop the bond prices. We will be in a loss. Although, as a client, you are buying the German bond, so you will receive a holding cost to it. But then, because the price drop, will still have a floating loss in your portfolio. The thing is, uh, we are looking this strategy from a longer term perspective. So when the deposit rates were extremely low, that time a bond or a German bond was around 250 or 260 euros. So at any point of time, if we see in the future that interest rates starts coming down, we will have a capital growth on our bond investments, and until that time, we will be continuing to receive the holding cost also. So that's that is one of the way you can diversify your investments and take advantage of the holding cost also, guys. Right. So these were a few ideas, friends. Thank you so much for joining this session. These were a few ideas which I wanted to discuss. And thank you so much for joining the session. Next week, we'll meet again with a different topic and with the different investment ideas. Until then, have a great week ahead. And if you have any questions, you can reach us out, can come to our office. We are definitely available for a one-on-one session. And if you need the copy of these portfolios, you can definitely talk to your RMs and they will give it to you. Right. So thank you so much. My name is Yogesh, and I'll see you next week.